the speed at which this market moves has just caught people by surprise.
The pendulum swing is something that, it's information, shouldn't be ignored, but it should be potentially weighted accordingly.
I expect there'll be plenty of volatility between now and whatever we call resolution. With the market being this short, uh, I think the only thing I will count on is volatilities.
Welcome to the Energy Desk, a podcast from Mobius Risk Group. In this series, we break down the macro forces and fundamental trends shaping global energy markets. We cover everything from geopolitics and policy to supply, demand, and the price risks that we're watching behind the scenes. Each episode is designed to cut through the noise and give you clear, actual insight into what's driving today's energy landscape and what it means for what comes next. You can follow the show wherever you get your podcasts. You can share feedback or ask questions by emailing podcast@mobiusriskgroup.com. Let's get started. All right, Mohit, we are back on the Energy Desk. A little over a month since our last crude-focused chat, and wow, what has happened since then? Yeah, how's Houston going this fine Friday? We're sitting here, just for reference, just before
Nice and
3:30.
steamy.
Nice and steamy. Yeah. 3:30, about to have a whole lot of heat set in over the weekend. And obviously, been somewhat supportive for natural gas, but more broadly for the global crude market. It's been quite a transition. And just looking back to where we were middle of May when we had our previous conversation, we were sitting with the prompt month at the time just under 108. And December 26th, about a month ago, was, over $80. And today we settled at 69.23 for prompt, August 26th. And, BAL 26, I can tell you right here, BAL 26, we're at 68.58. So quite a transition. And, similar to some of the questions that we've received since some of the MOU related dealings have pressured prices, what gives?
Yeah, I think the speed at which this market moves has just caught people by surprise. And I think just taking a step back, like you said, let's revisit where we were pre-2026, and there was supposed to be this massive glut, and people were saying, oh my God, we could see a four handle. And it seemed a little extreme, on what we were talking about here. And it's like, okay, it's bearish, it'll be oversupplied, but four handle seemed a little extreme. And positioning, of course, was following. It was very short. Then the war happened and the shorts covered and length came in and prices just rocketed up. And then after like a couple of months of crazy pricing, I call it crazy pricing because you have very, very high physical premiums. We talked about that here. And then things started to stabilize even before the MOU because there was chatter of an imminent deal. And you started seeing physical premiums dissipate. You started seeing the curve flatten, and length came in a pretty big way. And I think we went almost to the 90th percentile or something on the long side.
Mm-hmm.
And here we are after the MOU, and then everyone rushing for the exit and massive shorts again. I would say they're between the 90th and 100th percentile on
in the case of
Brent,
Brent.
and pretty high on TI as well. And here we are on spreads where we'd seen an M1, M2 of almost $15. And I think today is pretty much flat. I think Brent went contango. So yes, I think it's very driven by the fast money, which is not what people conventionally think. It's like, oh my God, inventories are so low. Why are we not trading 150? It's like, well, everyone is talking about the 150 and it's highly unlikely it'll get there if everyone's waiting for it. And now again, people are talking about the oversupply. You can elaborate on that. I think people were misjudging demand pause or demand slowdown. And the apparent missing barrels were in the, 15, 20 million is what they calculated. But really, when you were talking last time, I think it was much less than that.
Yeah. So even when we were in May, so, obviously conflict started around February 28th, kind of kicking off effectively start of March. So by the middle of May, what we were running down was what's the real calculus? Because everybody's talking about this, obviously it is a massive supply disruption, but what's the actual number? Is it the, 20 million-ish disruption that is frequently touted in the media? And in reality, when you actually do the kind of balancing between rerouting, dark transits, and all the other factors that play into that, it at the time was even dipping into the lower teens. And then since then, we've had just an increase in the dark transits, as you mentioned, when the deal related commentary was coming through, coinciding with that. And we got some news about this afterwards, but we were seeing indications that dark transits were increasing at a pretty considerable pace. Subsequently, got news that the US was actually helping support some of those transits through the Strait of Hormuz. And then the other factor, as you mentioned, that was not being really, I think, appreciated to the magnitude that it can adapt is the demand destruction. It's a slower moving, it's less elastic than some of the supply factors that we've had during this period. But once that momentum starts to build, it's not a linear change. And so that one was another factor. For example, China cut their crude imports almost by half between the start of the war and into May, and they were still about half or sharply reduced in June so far. So factors like that were not really paid attention to, and I think that's in some ways a helpful transition into where we go next. But one of the positioning pieces that you mentioned, I just wanted to put some numbers to because I think it's pretty interesting. So at the start of February, looking at Brent spec positioning right now, you had we'll go actually basically start of the year 100th percentile shorts for Brent. By the time conflict kicks off, we're still at the 80th percentile, and then roughly 6 weeks after that point, shorts had dropped to below the 8th percentile, and now we've made the full recovery back, as you mentioned earlier, to basically the 100th percentile. During that period, you had length go kind of inverse from that. So peak was kind of right in that end March, early April period, stayed elevated for a bit there, but has just kind of incrementally come off for Brent. But as we get into where we are now, so what has happened, just kind of a quick rundown. Obviously, most of the listeners are going to be aware of what's happening in the world, but just so we're on the same page, MOU conversation or MOU signed, now negotiations about all of these red line items. There's the massive bolus of supply that was trapped in the Persian Gulf that has now been kind of making its way through the choke point to various destinations, easing that immediate supply shock in a sense. And then you have the additional factor in there of production, where kind of before, say, prior chat type of timeline, the expectations were, oh, this is impacted production is going to be offline for, over a year type of time frame. We get to now, and why this was ignored, I don't really know, but through this whole period, we've had Kuwait, Iraq, and all these other Gulf producers talking about their expectations, and most of those expectations were indicating, 2 months or less to get a majority recovery for impacted production. And lo and behold, it's following the cadence that they had indicated before all of this, but we're getting, a faster than expected, quote unquote, expected production recovery for all of the, primary producers inside the Gulf. And then you add in Iran as well. Meanwhile, demand is still waiting to recover. So, the net change is, there's obviously, you can have a logical explanation for that. So,
Sure. And I'll just say, on the supply side, one of the things which is hitting is with this lower demand, call it pause, I wouldn't call it destruction, I would just call it lower demand. You're also getting all the backlog barrels hitting. So you're seeing that in physical premiums. They've gone from premiums to discounts. And now we've got a lot of people who are wondering whether it's going to be a massive glut again. And it could be for a short period of time because you have all these sanctioned barrels, the Gulf barrels, which are now coming out, and your demand is not back to where it was 3 months ago. So you may go through this period of excess supply and then waiting for the demand to catch up.
Right.
So,
And the pendulum swing and sentiment, I think, is just a entertaining factor of all of the different dealings that we have when we're looking at what's going on in the market. But, the IEA as a kind of indicative example of some of this sentiment prior to the conflict, they were kind of peak bearish, oversupply. And then during the conflict, this is the worst supply shock ever. And, we're weeks away from MINS, which they said initially in March. And then they said again in April and then again in May. And eventually you'll be right if it is prolonged enough. But we get to where we are now, where there's potential resolution. And the IEA goes back to, I think we're going to have, 5 to 8 million barrel surplus in 2027. So the pendulum swing is something that, it's information, shouldn't be ignored, but it should be potentially weighted accordingly. And then on the flip side, obviously, I think the anchor to the IEA is OPEC, who is generally on the bullish leaning side for oil demand. And they can support some of those claims, especially with, developing regions and things like that. But I think more importantly, when we look at the near term, there's a potential for some interesting developments in this, kind of before the end of 2026, but also before or in line with the August 60-day ceasefire kind of window that we have here. What are you paying attention to where we have kind of this total return to pre-war levels for prompt? The curve has changed dramatically. What are you watching right now, and maybe how does that relate to?
I think two things. One is coming back to one of the comments you made a little while ago was, yes, these negotiations are going on, but if you look at the red lines, they haven't been addressed yet. So I expect there'll be plenty of volatility between now and whatever we call resolution. And with the market being this short, I think the only thing I will count on is volatility. So if you get good, I call it good news in terms of we're moving along in terms of peace, you'll get gap downs, and then you'll get something like yesterday when there was an attack on a ship and they warn everyone, hey, don't come in. And some ships actually turn around. So that's going to cause potential hiccups to the upside. So I'd just say volatility is going to be pretty high in the next 30 to 60 days, given that.
Yeah. Yeah. And that's kind of hand in hand with that. When we look at observable inventories, really the US, I think, is a good example of the extreme condition where you have commercial crude inventories down to essentially second percentile seasonal levels relative to the last decade, products bottom decile, and Cushing lowest level since 2014, SPR lowest level since 1983. So kind of across the board, really have seen the impact of the U.S. exports coming into play to kind of rescue the immediate supply losses. You don't have a huge buffer. And when you have the shorts at the levels where they are, as you said, the apparent confidence in negotiations, I think, is just something to pay attention to because
yes, for sure.
Yeah,
for sure. And I think to come back to the inventories, I think even as we were drawing down, one of the ways people looked at where price would go is, okay, if we keep drawing at this rate, in 3 months, we'll be on fumes. Like, yes, but long before that, price would have moved to curtail demand so that you never get to that fumes level where, refineries are shutting down or things like that. So that's one thing. The other is we've talked about that here. Watch cracks. Cracks are still very elevated. It's not just the crude. Okay, so crude $70, call it round number. Cracks are still like $55, $65, gasoline, diesel. So watch what those inventories do. Distillate's been low for a long time. Does it start building? Gasoline, we are getting close to where typically it's the peak draws are done. Again, do they start building? They've been building a little bit in the past few weeks. Do they continue? What happens globally? That's really what I would watch. Is it's still not back to normal because crude's come off, but cracks are still elevated.
Yeah, exactly. And that's just putting some numbers to what you mentioned there on the products side for the US. The trend over the last few weeks for distillates, once this loads right here, there we go. So start of June, we were sitting at 102.3, and right as of end of last week, we're at 106.1. So now back to a year-over-year surplus, which last year was quite low at this time as well. But the trend has been indicative, as you said. And then for gasoline, pretty similar story where you were touching a low of just under 212 at the end of May, and we're up to 216. So just kind of incremental recovery from where we were, obviously at, decadal lows for this time of year. But that trend was also heavily weighted towards exports. And as exports come off, the relationship can be kind of interpreted from there. But so, the product cracks will be supportive. And then the other factor that I think is important to recognize as well, outside of the whole negotiation catalyst potential is just a demand recovery. So as China steps back in to the market, starts importing crude again, just over time, that'll be more supportive. The other factor as we look closer towards the end of 2026 that we obviously discussed at length before all of the potential resolution was on the table, and was just how the other Gulf producers are going to be thinking about their long-term supply conditions and their export viability. And so for the UAE, perfect example, as we highlighted before, they were one of the first to really aggressively try to restart their exports with their own operated transits through the Strait of Hormuz, doing ship-to-ship transfers and then exporting, near Fujairah, while running the pipe to Fujairah up, near max capacity, about 1.85 million a day. And they have since said, okay, we're going to double our export capacity by kind of early 2027 and simultaneously raise our production capacity to over 5 million a day. So you're from current levels about 4.4 or so, but they're only producing 3.5 roughly, also related to the OPEC exit like we've discussed. But as they kind of take this new independent path, that's one indication. Then you also have Iraq, who has a 2.5 million a day pipe network going to Red Sea and Mediterranean. And then the other piece that I think will be really interesting to watch is just what does Saudi Arabia do, because they rerouted through the East-West pipeline to Yanbu on the Red Sea, and that has a capacity of 5 million a day. They averaged about 4 million a day in May, while basically not exporting at all from the Persian Gulf. Persian Gulf, prior to conflict, was about 6 million a day. So total exports at that time were roughly 7. So what's going to happen? Are they going to keep the East-West pipe running while they also bring the Gulf exports back online? That's another supply question. So, it'll be, I think there's a lot of variables at play right now, and obviously the undertones delivered by the negotiations. As you said, we had the IRGC drone attack on a vessel yesterday, or was that Wednesday? It all blends together at the end of the week. But had more Trump-related commentary about that attack and potential violation of ceasefire today. So there's plenty of catalysts.
Yeah, and I think coming back to what you said, I mean, on either the last podcast or the one before, we talked about, UAE getting more barrels across. And then also, as they look long term, as a producer, they'll look to potentially provide tolling agreements to people who are locked into the Gulf. And I wouldn't be surprised to see that once they get their production out, then they say, okay, hey, we'll make another pipe and maybe you guys can help us build it. And that ties different countries together economically, which brings them closer. And I think Iraq might try going via the Mediterranean and expand on that side. And again, the more countries they go through, you'll get that economic cooperation, which makes them less likely to go to war and more likely to be, reaching any kind of diplomatic solution. So I think longer term, I think this is already accelerating. I mean, we talked about it. We said, okay, I don't know how long it'll take. Maybe it's a decadal view. Maybe it's much faster than that.
Yeah,
and what
like
we'll find is everyone was so worried over the past 20, 30 years about the choke point, Straits of Hormuz, right? And now that it's happened, I think the countries who are importing, they'll want to diversify away from that. And the producers will say, okay, I don't want that as a choke point. So I think over time, it'll just become a sort of nothing burger. That's a very technical term, but I don't think it'll matter anymore going forward.
Yeah. Yeah, it'll be interesting to see how the conversations around the Strait of Hormuz tolling between Iran and Oman as kind of the primary parties of that commentary right now, how that drives any subsequent investment decisions or announcements related to non-Hormuz export opportunities. So, there will be plenty to figure out in the near term. The Hormuz toll is a big one. There's not really much agreement, it seems, on the nuclear conversation yet. So those are really the two reasons for negotiations in the first place.
The missiles and the proxies, I think those are, again, part of a big thing. So like we've talked about, it's like the red lines are still very, very far apart.
Yeah. Yeah. So it'll be, plenty to keep an eye on both sides. Lots of variables in either direction. But anything that you want to hit on, I think today we can keep it kind of short. I think we covered a lot of
the only other thing I'll say, it's nice that one of our prior ones, we said, hey, everyone's looking at the upside. Maybe we should also look at the downside. I had no idea that it would be so quick, but at least we did alert our
Yeah.
listeners to that a while ago. So I feel good about
Yeah.
that.
Yeah. And again, the pendulum swings.
Yeah.
And
Oh, yeah.
so,
This is not over. This is not
yeah.
over.
Yeah.
So,
Being able to detach from the just frantic commentary in either direction on the
mhm.
media is seemingly more important than ever. So yeah, with that, I think we can, come back as developments happen and update, whatever we see fit. But I think that's a good, 20 minutes or so for
Yeah,
today.
I think that is great.
Awesome. All right. Thanks, Mohit.
Thanks, Alex.